Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming Professor Henry Friedman. Henry Friedman is an associate professor of accounting at the University of California, Los Angeles. His research related to how information is produced and used in firms and capital markets using theoretical models and archival data. His research has been published in top ranking journals in accounting, finance, and management journals, such as the Journal of Accounting and Economics, Review of Accounting Studies, the Review of Financial Studies, Journal of Accounting Research, the Accounting Review, and the Management Science. Friedman previously taught at Wharton Business School and MIT. Now we will start our seminar with Professor Henry Friedman.
Cool. Thanks very much for the kind introduction. Also, thanks a lot, Mohammed, for the opportunity to talk about some of my research and what I think is a really interesting topic. So, are people able to hear me? Does the screen sharing seem to be working? Let's see. Okay, I'm seeing some thumbs up. Thanks very much. Really appreciate that. Just want to make sure I'm not going to be talking to myself for an hour. So that's great. So the title of this talk is Implications of Investor Interest in ESG. That's environmental, social, and governance. Probably going to be, when we say ESG, probably would like you to think about more the E and the S as opposed to G, and we'll get into why that is in a little bit. So I've had the pleasure of sitting in on a few of these seminars, and I guess early on they seem to be talks where people presented more of an idea or presented their work across a few papers in a given area. So I'm gonna go with that mode as opposed to presenting a single paper and I'm giving a more traditional workshop. So the plan for today, it's a discussion built around 3 papers, all co-authored with Mirko Heinle, who's at Wharton. The first one was published in RASC back in 2016, Taste Information and Asset Prices. The second 2 are working papers right now. The first of which is Interested Investors and Intermediaries. The second of which is co-authored also with a PhD student at Wharton, Irina Luneva. That one's very new, titled A Theoretical Framework for Environmental and Social Impact Reporting. And hopefully I'll get to talk about each of them in turn after setting the stage a little bit. So my goals today, this morning in Los Angeles, evening in Cairo, and other times in between, my goal is to generate an interesting discussion as well as questions related to ESG policy and research. So with that in mind, please feel free to ask questions using the chat, raise your hand, or if you'd like, you could just unmute yourself and chime in. If you don't have a question, just to help minimize background sound interruptions, please just keep yourself muted. It seems like overwhelmingly people are muted. So thanks very much for that. Okay, so just starting off with a little bit of motivation. I'm not even sure how much motivation research on ESG needs. It seems like I don't know how many of you get these daily emails from SSRN. It seems like there's 5 papers about ESG every day. So, but I do want to just emphasize that there's interest at a number of levels in getting in firms' performance and activities related to environmental, social, and again, governance activities, mainly because these are global issues that, if not addressed, will create global problems or are already creating global problems. So we've got things like climate change, which is clearly in the environmental sphere, extreme weather events, of course, plausibly related to climate change, or I think the link is quite strong, actually, based on the scientific consensus. On the social side, you've got issues of worker treatment, discrimination, fairness, equality. And on the governance side, we can think of traditional governance issues like preventing expropriation by managers, but we could also just think of managing risks and potentially governance as it relates to long-term sustainability related to climate and or environmental and social dimensions as well. So lots of things that firms do affect people regardless of whether they're investors or equity or credit investors. So there's a lot of societal concern in corporate ESG. On the investor side, there also is huge and growing interest in ESG. So the US SIF Foundation tracks this. What they show is that the assets allocated to funds with ESG goals have really grown exponentially since around 2010 or 2012, with assets under management topping 14 or 16 trillion in recent years, and that's trillions of dollars. So really, there's a lot of investors who are interested in this, both at the individual investor level, at the asset owner level, as well as at the fund manager level. Finally, academics are really interested in this. So this is just screenshots of a few conferences, recent conferences and upcoming ones. So some of you may have participated in the CARE conference this past couple weeks. There's an NBER conference coming up on measuring and reporting corporate carbon footprints. Both JAR and RAST, the upcoming conferences, have to have at least a bit of an ESG tilt. And there's other organizations that have been running, say, sustainable finance conferences for years and years. So really, there's no shortage of interest in this quite important topic. So what are my goals and questions, or in this area, what are the goals and questions? Well, I would think of breaking it down in terms of three broad categories of goals and questions. So we could think about normative questions, and this is really targeted at a research audience. So this isn't how do we maximize fund flows by focusing on ESG, or maximize returns focusing on ESG, or something on the corporate side. So really, from a research and policy perspective, we could think of normative goals, like how do we move towards solutions to global issues? How do we generate policies that will mitigate climate change, reduce hazards or risks related to severe weather events? On the positive side, that is the positive research side, we could think of questions like how and when do corporate actions reflect stakeholder or investor preferences? How do investors respond to corporate actions? So how does the world actually work when it comes to ESG, and from an accounting perspective, ESG information? And then we could think about mechanisms. Frictions would also be here under this category. So what roles do capital market structure, so how investors invest, or how information gets aggregated into price, mechanisms like disclosure, factors like investor or other stakeholder preferences, how do those matter? And of course, those are going to be relevant for both the positive and normative questions as well. So much of my research is theoretical, so economic models where you assume things about the players, and usually it's what are the frictions that impact what outcomes occur in equilibrium. So for me, from my perspective, it's really useful to think about what are the key frictions in the ESG space. And it's the frictions that really generate the outcomes of interest, or contribute to generating the outcomes of interest. So one is whether ESG activities maximize discounted cash flows, or is there a friction between activities that are in pursuit of ESG goals versus maximizing discounted cash flows? If you can always do well by doing good, that is, if the sustainable activities always improve cash flows, then we don't really have, from a corporate finance or accounting perspective, we don't really have to think as much about what's the role of ESG per se. Firms are going to be intrinsically motivated. Firms that are interested in maximizing discounted cash flows are going to be intrinsically interested in maximizing on the sustainability dimension too, as long as they're completely aligned. If there's a friction such that they're not completely aligned, and I think there's a lot of good examples of them not completely aligned, then of course we have to think about what are the trade-offs that are made between the two, or between many dimensions of ESG performance. Second, the ESG space is really characterized by externalities and free riding. So pollution is a classical case of an externality where one entity's actions affect another entity's payoffs or benefits. So ESG in general often has public benefits, even though from a firm perspective, there are private costs to things like pollution mitigation. Individual actors in general, we think of them as maximizing their private benefits. That's a sort of a foundational economic assumption. We can play around with what private benefits mean, but in general, we think of parties maximizing what they get out of an action, and not necessarily taking 100% of putting 100% weight on concern for externalities. So given that you get issues of free riding on public goods or externalities that can lead to either under provision of public goods, plundering of public spaces or resources. Many of you have probably heard about this in terms of the tragedy of the commons. Finally, we have frictions related to preference disagreement. So even within ESG, there could be differences in what do we think the right strategies are, how much value do we put on different outcomes. So how much is a dollar of carbon worth versus how much is mitigating inequality worth, for instance. That's an area that I don't think has gotten as much interest, but I think it's going to be getting more interest as people do more to measure what these preferences over ESG outcomes are. So once we get a little bit better of a picture in that dimension. Also, there can be preference disagreement just in terms of some people care about ESG, some people only, as investors, maybe only want to maximize cash flows. The concern over ESG could be related to pure altruism, like I just really want to do good in the world, sort of like Muhammad's motivation for putting together these seminars. I just want to put out something. It's going to be a little bit privately costly, but other people are going to benefit from it. Separately, you can have an impure altruism, or what Andreoni calls a warm glow motivation, where you get a personal utility benefit from being associated with something. So I want to buy, for instance, Apple stock because I just think Apple's a really good company, and by virtue of owning the stock, I feel like I participate in their goodness, even though I'm not really doing anything that changes what they do. So that's what's called a warm glow. Okay, I don't think so. I'm going to get into some specific research papers. There aren't questions so far, but maybe that's just because this is more of a setup motivation, big picture. Nothing I've said I think is too controversial just yet, or it's probably pretty clear. We could think about, from a research and policy perspective, also there's levels of policy intervention. And where I'm going with this within a slide or two is, where do we see ourselves as accounting, finance, econ researchers in terms of contributing to the conversation and helping both on the normative and the positive side? So what I've got on this slide is a hierarchy of policy intervention. So at the top, basically going from more restrictive to less restrictive as you move down. So at the top, let's see if I can point that way. It almost works. So at the top, we've got mandates or restrictions. Governments can just pass laws. You can't pollute in this river. You can't, emissions have to be below a certain level. You have to post a bond to mitigate environmental effects even after you close a power plant. That can be done. At the slightly less restrictive side, governments can also introduce taxes, of course. So we could think of Pigovian taxes that try to get entities to internalize the externalities of their actions. We could also think about the creation of markets, like markets for carbon credits, where we get parties to internalize the monetary value of their actions but we allow the pricing to be set by a market. Okay, so we allow demand and supply to work, which can be beneficial. At a lower level of government intervention and really potentially minimal government intervention, we have investor or stakeholder pressure. So for this, investors or stakeholders need to have information, and this is where I think the accounting researchers are going to play maybe a bit of a larger role. But this, of course, relies on public or stakeholder pressure as well as disclosure. So if we want companies to stop using certain kinds of labor, maybe we'll do that in response to customer or investor pressure, but that's really got to be something that those customers or investors care about, and they've got to have information about that. I think it's useful to think about also, why is this hierarchy important? Well, it's because the levels of policy intervention have different costs and benefits and requirements for information. So if we think about mandates or restrictions, you've got to get government to act. And government's actually going to be restricting rights of some parties. I come from a US perspective. I know that can be really complicated. You get lobbyists involved. You have parties arguing and suing the government, saying the government doesn't have a right to regulate this. Maybe different levels of government do or don't. So it can be really hard to enact. Once it's enacted, it can be hard to adjust. there's private information, there's evasion. It could also be really costly to enforce. So measuring and punishing firms for certain types of emissions can be quite difficult because you've got to actually detect those emissions or motivate whistleblowers. You get similar problems or issues with taxes or pricing of externalities. They can also be difficult to enact and adjust. You can get a carbon price that's set too low. You can get taxes that are set too low or too high. Of course, you can get carbon prices that are, or initial carbon allotments that are too much or too little. You've got to set the rate of taxes. You've got to set the base of taxes. This creates evasion incentives for structuring around the taxes. On the pricing side, maybe incentives for shifting production such that you look, maybe the environmental impact doesn't change, but you've just made it so that you've got less exposure to either the taxes or the pricing. Last, investor or stakeholder pressure, they tend to not require as much intervention from the government. The policies from a government perspective, again, at least in the US, tend to focus on information or disclosure, although there are some interesting things coming down the road related to, in some sense, corporate governance structure. So what rights and when can, say, institutional investors get involved, proxy access, things like that. But for the most part, the policies focus on information disclosure because that's something that the securities regulators and exchanges tend to have a reasonable ability to enforce and to require. That being said, with investor or stakeholder pressure, there's a more limited scope for affecting actions. Right? It tends to be, these tend to be things that hit investors or stakeholders more directly to get that pressure. So if you've got labor practices or pollution that are out of sight and out of mind, it's unlikely that investor or stakeholder pressure is going to play a role, even if there are eventually externalities that play through. Okay, so Robin Roberts asked a question in the chat. How do you think about differences in corporate ESG risk management and normative measures of ESG performance? That's a really big question. So at a generic level, there's just different actions that different companies take. And again, this is maybe colored by my perspective of mostly working with theoretical models in this space. So I think what we want to think about, what I'd like to have in the back of your mind is maybe what makes ESG different from any other corporate action. And a lot of it, I think, comes down to differences in how different stakeholders value it. It's not just, does this increase or decrease cash flows, or is someone stealing cash flows? So differences in corporate ESG risk management, it's going to be, I think, similar to differences in regular risk management, but plausibly with differences in horizon or preferences across stakeholders, managers, employees, things like that. And then normative measures of ESG performance. So when I think of the word normative, I think of, from a research perspective, we're saying, here's how something should work, as opposed to positive research characterizing how do things seem to work based on evidence potentially, or theory and evidence. So what, if you don't mind chiming in, Robin, what do you mean by normative measures of ESG performance? What does normative mean in that context?
Yeah. Hi, I don't know if you can hear me and see me.
Yep.
Is that okay? Right.
Yep.
So normative, I mean, like I've noticed in ESG risk management and in my discussions with ESG rating agencies, ESG ratings about environmental performance, for example, can be low if someone moves their pollution to a less regulated environment. So ESG risk management is not about a normative scale about reducing environmental damage. It's more about the corporation adjusting the way in which they produce pollution to a place where they're at less risk to investors in terms of negative repercussions. So that's where I was coming from on that. I hope that helps.
Yeah, no, it does. And I think this, I think what might be useful to keep in mind is that risk can mean a lot of different things when we talk about ESG risks. So many of you have probably, and Robin, thanks for bringing this up. There's physical risk, there's transition risk, and I think and transition risk often is speaking about, well, this is a little bit carbon focused, but I think regulatory risk comes into play with transition risk, but it's not necessarily the same thing. So certainly from a ESG risk management perspective, there's doubtless lots of firms that are taking this is a regulatory issue. So we need to figure out how do we mitigate our exposure to negative either enforcement or regulatory outcomes, as opposed to thinking about are we trying to mitigate, say, physical risk or risk that's imposed on other players. And I think it's not something I've thought about directly that much, but I think it's a really important thing down the road. I mean, I think it's a really important thing now. I just haven't seen a ton of research on that aspect specifically.
Right. Thanks a lot. Thank you.
Yeah, no, great question.
Yeah.
Okay, so cool. So where does accounting research fit in? Well, if we think about the first two policy levers, mandates, restrictions, taxes, and pricing, we've got accounting research often comes in terms of measuring effects on firms and stakeholders. So maybe this gets at Robin's comment also a little bit. How do firms respond to mandates or restrictions or to regulations or taxes? How do the internal processes relate to that in terms of how risk is measured inside a firm, how it's communicated to external parties? And actually, as I'm talking about this now, I think about like the risk factors in the 10K. Lots of firms have boilerplate risk factors, but often you see there's some chance that the government will say that what we're doing is problematic or illegal. We've seen this in China pretty recently with both online gaming and online education or private tutoring, where the government basically said, we think these things are bad for society. We're going to restrict profits from being made on them. Okay, so how are the companies that do that reacting? Those are serious risks that, it's a little bit different in China than in the US. It's a little bit harder for the US government to just outlaw certain activities, but certainly something like we're not going to allow Facebook to create a version for tweens, or we're not going to allow tobacco companies to market bubblegum flavored vaping pens or fillers, whatever they are potentially social related risks that firms take and face, and risks that are associated with their cash flows. So that being said, I think where we really see a lot more in terms of the accounting research is related to, or at least where I've seen a lot more, is the disclosure that's targeted at investors or stakeholders, potentially facilitating pressure that they might exert. So we could think about causes or consequences of disclosure choices that firms make. So what do they say about risks that they're facing? What are the implications of differences in disclosure? And I'm not going to get into, this isn't really meant to be a literature review, just to point out that there's a lot out there. And this is a fastly expanding area. There's feedback effects of disclosure on corporate actions. So if I make a disclosure, how does that affect my incentives? Interactions between disclosure and market structure. I'll get into that a little bit in terms of thinking about what role do intermediaries like fund managers play. And then I think where some of this literature started was whether ESG disclosures convey financial information. Are they material in the sense of affecting investor decisions? And some of that is predicated on the notion that sustainability practices are relevant for long-term financial performance. But one thing I'm going to try to point out as I get into talking about the papers, and I'll probably have to speed up a little bit, is just that looking at investor responses doesn't necessarily tell you about cash flow materiality. It could also just tell you about investor preferences. So Amna says corporations may selectively disclose positive ESG disclosures while hiding the negative ones. How can an investor detect the immateriality regarding financial sustainability? Let's see. So yeah, it's certain. I think this is a hard problem that investors and policymakers face, which is essentially, when do you get greenwashing or cheap talk in terms of companies saying they did a lot? One area where you see this in the business press a lot is with firms saying that they're carbon neutral, but potentially by buying carbon credits. And sometimes those carbon credits involve trees that are not cut down. So if all you want to do is say that you're carbon neutral, then that's great. But if you really want to think about, are you having a net zero effect on the amount of carbon in the atmosphere, you'd want to think about, well, what would have happened to those trees that we paid someone $2 per tree, and that's a made up number, apologies for that, to not cut down. So I think this is a really difficult issue, but it's an issue that we face outside of ESG also. You get firms frequently say, we're making these really valuable long-term investments, and frankly, there's uncertainty about whether those investments are going to pay out. So there's inherently information asymmetry and uncertainty about the payoffs or benefits of investments. But the other point that Amna brings up is selective disclosure. So I haven't seen a ton on voluntary disclosure, theoretically on voluntary disclosure in the ESG space, but most of the disclosures so far have been voluntary. So substantially all of the empirical research has been on voluntary disclosures, with the exception of a couple papers on things like, let's see, conflict mineral disclosures and disclosures not targeted at investors, but that are required to be made to, say, the EPA. At least that's what I've seen. David?
You just mentioned the conflict minerals disclosures just now.
I did.
So I am interested in that topic. So I see that it is a mandatory disclosure, but then although it's mandatory, if there are no penalties to not filing the disclosure, then how is it mandatory in that sense?
I don't know. I'd recommend looking at the, I don't know much about the institutional detail. It's a good question. It's just not one I can really answer.
Okay, I will continue to listen to your presentation. Thank you.
Okay. Yeah, I mean, it's a good question of where's the line between mandatory and voluntary disclosure. And I think it gets blurry also when you have, say, comply or explain. So firms will say, we're not doing this, and it's not really relevant. And then you have to, building on Amna's question, be a judge of whether a given issue it's relevant, or the firm's making an improper judgment on that space.
May I just ask one follow-up question then?
Yeah.
About the learning costs that are involved with these ESG disclosures?
Yeah.
So would the firms have to make a choice of whether they would like to learn about like what's going on within their firms in regards to these conflict minerals? And also, there's a choice.
I think that's something that the regulators consider.
Yes.
So I think that goes into something related to comply or explain. But I'm sorry, it's not something I've really studied. There's a couple papers on conflict mineral disclosure. I really just meant that as an example of an area where the SEC said, you've got to say something about this if it's relevant to you. And frankly, you see I think for the most part, you see the firms that you'd expect to saying something about that. And then like Microsoft is just saying they've got a section header and this is not relevant to us. So.
Yes. So that's a very good example. So in that case, they decided to not learn about it because they're a software company. I think although they do have, some products now like the Surface and so on, but then is it better to just make a statement like that saying like, I don't know, and not
I think there's a difference between saying I don't know and this is not relevant. I mean, you don't know to what degree they looked into their supply chain. But I think probably and this is just me speculating, your average investor is going to think about what the business is and say, how likely is it that there is a conflict mineral issue that's knowable by them versus not. So I mean, I don't want to spend too much time on this, but once you get especially into like second level supply chain issues, I think firms only have so much visibility into that. So yeah, it's an interesting issue. And I think there's a lot of, above and beyond conflict minerals, there's a lot of issues related to ESG or CSR in supply chains. I think there's one of the JEE conference papers coming up, I think has to do with that, although I haven't read the paper. I've only seen a title, but yeah, it's an interesting area. But again, I'm sorry, I don't know much about like what firms that might have conflict mineral issues are saying in that specific part of the 10K.
Thanks for your time, and
Yeah.
I'll send an email separately so that we
Okay.
can continue to present.
Cool. So Robin says, looking at accounting CSR reporting literature, lots of relevant studies. Yeah, totally agree. Totally agree. Cool. So the first paper I want to talk about a little bit is it's called Taste Information and Asset Prices, Implications for the Valuation of CSR. All three papers are theory papers. So and that's why when there's really good questions about institutional detail or how things work with regard to a specific disclosure, the way I'd like to think about those is more along the lines of what are the frictions. But at this time, I don't really know a ton about what does enforcement look like with regard to a specific type of disclosure. Okay, so we've got a one period competitive capital market. There's symmetric information. So everyone has the same information. We're not concerned about information asymmetry, which is something that a couple of you have brought up, especially with regards to what do managers know or might know or choose to know that investors don't. So in this case, the firm is really just a risky asset. So there isn't anything that the firm decides to do for the most part. And there's no information asymmetry between investors. We think of the firm as having some cash flow performance and ESG or CSR performance. Just in terms of literature, I think about, if you go back a few years, I think people were using the term CSR more, corporate social responsibility. That term or acronym seems to have fallen out of favor a bit, and really ESG or environmental and social impact or social response, other acronyms seems to have become much more prominent. Anyway, in our model, we assume cash flow and ESG or CSR performance are independent, and that just helps clarify the effects, partly because we look at, I think in an appendix, what happens if you allow them to be correlated, but it's not necessary. You get interesting effects even if they're not correlated, even if sustainability performance is not associated with cash flows. So in the model, everyone cares about cash flows. Some investors also care about ESG or CSR performance. And the way that they care is through warm glow, or what Andreoni called imperfect altruism. That is, their utility is increasing in the firm's ESG performance. So if Microsoft says they're treating their suppliers well, says they treat their employees well, I'm more happy to be an owner of Microsoft shares. And my happiness in terms of owning Microsoft shares is even higher the more Microsoft shares I own. So it's sort of like a cash flow in that it's a per share value of the firm doing positive things. Additionally, we assume that investors are risk averse in their ESG performance. I think this is an area where there's not a ton of knowledge about the risk preferences of people over ESG performance of firms. So I think that's an area where it might be useful to know a little bit about what are people's preferences actually. Also, one thing that we point out a bit in this paper is that heterogeneous preferences are not the same as heterogeneous information. So what do we find in equilibrium? Well, ESG is priced. So because some investors care and they just get a warm glow from holding shares, that increases their willingness to pay. So price is increasing in expected ESG performance, it's decreasing in expected ESG risk. So tying this back to David's point, if you are concerned that a firm is doing something problematic on the conflict mineral side and they're not disclosing, that means there's risk associated with what they're actually doing from an information perspective. So you would discount them in terms of how positive you feel about what they're doing. Okay? That's really where the risk potentially comes in from a pricing perspective in our model. They can mitigate that by doing better disclosure, but of course the disclosure is going to convey information that might have a first moment effect, move the mean, also move the conditional mean. The price impact of ESG depends on investors' warm glow valuation. So how many investors there are that care about ESG or CSR and how much they care as well. And then in general, share prices reflect a weighted average of the investors' preferences. Okay, so how much weight investors get depends on their risk aversions, depends on how much they value cash flows versus ESG or CSR, and how many investors there are who care about ESG. One thing that's interesting that you also see in a nice paper by Fama and French in 2007 is that heterogeneous preferences over ESG create what you might call a clientele effect. So some of you might be familiar with research on tax clienteles, where some investors hold different types of firms because they have different types of payouts, and investors have different types of exposure to taxes related to different types of payouts. So if I'm a tax exempt investor, I don't want to hold low yield municipal bonds because I don't get a tax benefit from that. We get a similar thing related to ESG. Differences in preferences lead to differences in portfolios. So what's interesting is that everyone gets pushed off of the cash flow efficient portfolio. The ESG investors do because they like the ESG performance. The other investors, even the investors that only care about cash flow, get pushed off of their otherwise optimal portfolio because ESG is priced. And if the price of ESG goes up, well, those traditional investors are not willing to pay, so they hold less of the risky asset. Again, pushing them off from an equilibrium balance between the risky and the risk-free asset. Also, the heterogeneous preferences give us a rebalancing trade between the two different clienteles when information comes out, even though there's no information asymmetry, which is somewhat different from previous results saying that absent information asymmetry, you don't get any trade when information comes out, the price just adjusts immediately. So we also observed some interactions between ESG and cash flows. So the clienteles depend on the relative risk and return characteristics of cash flows and ESG. So you get some interesting interactions between the two. Another interesting implication of our model is that ESG clienteles create motives for spinoffs. So one thing that's going on in our model is if you've got cash flow and ESG, a firm that has cash flow and ESG characteristics, and investors care about both of those, well, investors would potentially like to trade on those two things separately. You could think of this as a complete markets problem, but they're bundled in the firm. So investors have to buy cash flow and ESG proportionally based on how much the firm is doing of the two. So a spinoff can help complete the market if we can separate some of the ESG aspects from some of the cash flow aspects. We can get benefits to both firms. We can get different clienteles in both firms as well. And this is somewhat consistent. Even though this was a while ago, I think the example we use in the paper is Altria spinning off from Kraft. So separating cigarettes and snack foods. But we see a recent example of this also in terms of Royal Dutch Shell spinning off a bunch of their Permian Basin natural gas assets to ConocoPhillips. So I don't know if people can read the caption to the picture, but Conoco's deal with Shell shows that large independent oil and gas producers can get away with splashy oil field acquisitions given the right price and economics. So Royal Dutch Shell has a lot of investors who care about ESG. They're a Europe-exposed oil and gas major. ConocoPhillips is more concentrated in the US, doesn't have as much exposure to investors who care about ESG. So they seem to be, from a financial perspective, a better holder of these assets. Now, there's a separate issue of, is there a global benefit if we're just shifting from one pocket to the other? And I think this gets back a little bit to Robin's question or comment. So Royal Dutch Shell looks good, but maybe ConocoPhillips is actually going to exploit the Permian Basin fields more heavily. And this might actually lead to rising carbon emissions. But what we see when the deal was announced, the price of both ConocoPhillips and Royal Dutch Shell both reacted quite positively, which is consistent with the shareholder base is reacting and being able to shift a bit. Another thing that I think is useful to point out, and this is maybe something that I'm just trying to figure out, there's a number of studies that look at market reactions to ESG information and infer that ESG information is cash flow relevant potentially, or is material to investors at least. So firms do well by doing good. The thing is, if investors care innately about ESG performance, then stock price materiality, that is a price reaction to ESG information, does not imply cash flow materiality. It just implies that some investors care about that. And I think that's a general comment about what is it that firms are doing. So if there's a positive price reaction to change in board characteristics or governance policies, there could just be some investors that believe that's the right thing to do, and they'll reward firms somehow, even though it's not necessarily directly tied to cash flows. So it's not that there's no link, it's just that this evidence does not imply a link unless you get rid of the potential for investors to just care directly about whatever it is that firms are doing. Separately, of course, stock price maximization can incorporate ESG or CSR performance if investors care about it. So if you have a bunch of investors who care about it, then managers who maximize price are going to pursue those kinds of activities involving the boundary of the firm, also potentially involving investments that they make. And ESG or CSR outperformance over time could reflect changing preferences. So this is really related to the first point. Changes in preferences can lead to changes in the investor base, which could lead to changes in prices. And there's a neat paper. It's a NBER working paper by Pastor, Stambaugh, and Taylor, basically finding that, I'm just going to read the first two sentences from the abstract. Green assets delivered high returns in recent years. This performance reflects unexpectedly strong increases in environmental concerns, not high expected returns. Okay, so over the last several years, there's been increasing emphasis in how green firms are. So they generate a green factor. They plot that against a measure of climate concerns. And they find that those two are highly correlated, which is at least consistent with the idea that the degree to which green performance is priced is strongly associated with how much investors care about green performance. Okay, so it's not necessarily evidence prima facie that green firms do better because green investments are, the cash flow maximizing ones to do. Okay. Jumping into the next paper, which is a little bit more about the structure of the market. So try to speed up again a little bit. So we've got the paper's called Interested Investors and Intermediaries. When do ESG concerns lead to ESG performance? So again, we've got a single period capital market setting. We've got a firm, the manager takes an action that affects cash flow and ESG. So now these two things are conditionally correlated. They both depend on the same underlying action. So this could be a supplier, this could be a supplier choice. This could be like, what kinds of energy do you use? What kinds of emissions, mitigation investments do you make? We've got both investors and fund managers, really one fund manager in most of the paper, who care about the action that the manager takes. Okay, so they might prefer actions that lead to more positive ESG outcomes. They might prefer actions that lead to more positive cash flows only. And above and beyond that, both investors and the fund manager can exert a costly influence activity. So this could be maybe shareholder voting, maybe getting on the proxy shareholder proposals, maybe getting involved in proxy contests, things like that. So when there's no intermediary, we've got a continuum of competitive investors. All the investors are small. Each individual investor is small. So nobody finds it worthwhile to exert costly influence efforts to have because any effort that you take is going to have a personally private cost, but a minuscule effect on what the firm actually does because you're a small investor. What does that mean in equilibrium? Corporate action is independent of investor preferences. This is a classic free riding problem. It goes back to you can go back to Berlin Means in the 1930s, talking about how essentially agency problems or governance problems of dispersed ownership. It's the same thing, but with ESG preferences. If we introduce an interested intermediary, well, the intermediary or fund manager, they represent a set of investors. So we get over this small investor problem. That means that they're going to exert some costly influence efforts the way we model it, they're balancing the preferences of the intermediary and the portfolio investors. But in equilibrium, the intermediaries, it's a costly effort to influence the firm. So they've got to pass that cost off to someone. Naturally, it's going to be passed on to the investors. So now if you're an investor, you say, well, do I want to invest with a fund manager or do I want to invest directly? It doesn't change what the firm does because one more small investor in the intermediary doesn't change things. Doesn't change the action that the intermediary takes. But if I invest through the intermediary, I got to subsidize the actions that the intermediary takes. There's some, fund fee. So I'm just going to invest directly in the regular market. So what does that do? That drives out intermediaries who exert costly influence. So when we endogenize the investor allocations to the intermediary goes away. We go back to the all direct investing model. So corporate actions are still independent of investor preferences. One thing that's interesting, and I don't think we're the first to point it out, but other frictions can restore investment through the intermediary, things like costly direct investing. If you've got multiple intermediaries, then search frictions can play a role. Information asymmetry, so if the intermediary actually has some information that allows for more efficient investments, or let's say you're like me, you know that if you invest on your own, there's a potential you're going to make a mistake because you're going to wake up one morning, the sun is shining, you're going to feel like, hey, it's a great day to invest. But of course, that has nothing to do with capital market performance. So to avoid making mistakes, you could just invest through the intermediary, park your money in an ETF, and just go out and enjoy the sunshine. So these other frictions make it worthwhile for investors to invest through the intermediary. So what does this mean? Well, let's say the intermediary wants to attract portfolio investors. What does it want to do? Well, it benefits from these other frictions being higher, but it doesn't really have much say over them. What can it do? Well, it wants to be in a world where it can economize on the influence efforts that it undertakes, because the more influence it undertakes, the more cost it bears, the more it has to pass on to its portfolio investors. So what the intermediary wants is mechanisms that allow it to commit to economize on influence efforts. What allows it to do that? Well, having aligned preferences with corporate managers. So that's consistent with intermediaries being concerned about governance. So, if you look at statements by BlackRock and Vanguard, they're really concerned about governance and stewardship, but they frequently vote with management. Okay, well, that's because aligned preferences can be beneficial. It's also to some degree consistent with investing in firms or choosing your portfolio to be consistent with your preferences. For instance, if you're an SRI investor. Heath et al. Have and that's, I think, the Heath et al. 2021 paper. Actually, I think there's another Heath et al. 2021 paper that Daniele, one of the authors, is presenting later today at UCLA, actually. Who has more say in ESG investing, asset owners or asset managers? I think so what I'm talking about right now is a stylized model. I think at the end of the day, hopefully it's the asset owners who have more say in ESG investing because they're the ones who choose whether to delegate to an asset manager or to delegate directly. There are also some really big asset owners out there who are really important, like the Sovereign Wealth Fund of Norway. I think the Catholic Church has a reasonably large endowment that pursues social goals to some degree, at least. So those would be big asset owners. But if you think about if it's small asset owners, then it's plausible that asset managers are going to be playing a larger role because the small owners like retail investors, the aggregate fund flows are going to matter, but the individual decisions maybe don't make as much of a difference as the decisions made by the asset managers. So in some sense, the big friction is, are you big or small in this space? And of course, small in a competitive market is really, it's an extreme, but it just means my benefits are quite small relative to my private costs, my benefits of public actions. So we look at a couple other extensions, one where there's cross-firm externalities. So if one firm, say we've got an upstream manufacturing firm, they can pollute a river. That's going to affect what happens downstream, the quality of the water downstream. So how does that affect what the intermediary or fund manager does? Well, it gives them if they own both firms, it gives them a stronger incentive to get the upstream firm not to pollute. But they actually would rather be in a situation where the upstream firm is either not polluting or the downstream firm is at another stream, because that would allow them to not exert any influence action. They would be able to economize on influence again. So the negative or positive externalities can put them in a potentially problematic situation. And then the last thing that we look at is index investors or block holders. The way we model these are we have another investor who has a large stake. So this could be the Sovereign Wealth Fund of Norway. It could be an index fund who's pretty much stuck holding however many shares they hold. The key is that they've got a relatively fixed number of shares, at least in the short term, in a given company. So they're going to exert some influence. And now you've got a game between the different types of, between the fund manager and the block holder or index investor. And again, the fund managers just would rather be in a situation where they can push some of the efforts off to the block holder or indexer. So some key takeaways here, and I've probably hit this point a couple times, but really free riding is quite important in this setting. So getting corporate actions to reflect preferences requires overcoming free rider problems. One thing that Mirko and I noticed working across this paper and the previous one is that overcoming free rider problems is hard if what you care about are outcomes. Okay? If I got to exert a costly action and what I care about is the eventual outcome, like how much carbon is in the atmosphere, I'd rather sit back and let someone else deal with it. I still really care about the outcome. I just am not confident that whatever I do is going to make that big of a difference. So you've got to overcome this collective action problem. An area where you don't have to overcome the collective action problem is if investors have a warm glow utility. So instead of caring about the outcome, I just want to do stuff that helps mitigate carbon emissions. I just feel happy about doing that. Well, now I don't care about free riding because I actually get a private warm glow benefit. I don't know if this is necessarily an accounting question, but I think maybe something that some of our more behavioral oriented friends can help us tackle. What do preferences actually look like? So do investors care about the outcomes, which I think is in some sense what we should care about, or do investors care about warm glow and just feeling good about investing in companies that seem to be doing well? That's described as impure altruism. It sort of has a negative connotation, but it can be beneficial in helping overcome free rider problems, which can be pervasive and problematic. Interestingly, this is, of course, not the only context where investors ignore free riding problems. So in the US, getting people out to vote is a huge issue. I'm not saying it isn't in other countries. It's just something, I'm in the US, I see this come up every couple months. In California, we recently had an extra election involving the state governor. So there's just a lot of emphasis on getting people out to vote. Why is there so much influence? Well, I think it's trying to get people to have a warm glow of doing it as opposed to just caring about the outcome. Because if you think about it for 2 seconds, you know that one vote out of 10 million or 5 million or however much it is very, very unlikely to sway the outcome. And you've got to, I don't know, walk to a ballot drop-off thing. There is, at least some minor costs associated with actually voting. So there are mechanisms to help get people to care about this stuff. And I think some of the direction that things are going is pushing towards warm glow with ESG. There's also in this paper, we get at the role for intermediaries. They can play an important role in aggregating preferences, aggregating influence across small investors. So this gets a little bit about that. It's related to Robin's last question in the chat window. Who has more say in ESG investing, owners or asset owners or asset managers? And intermediaries can play a possible role in overcoming free rider problems. But of course, they introduce other problems that have been studied in other research, like agency costs, fund manager selection. If I can raise a bunch of money, and I have a pot of money that I control, that of course creates some other potential issues. Okay, so finally getting to the third paper. Going to introduce it as follows. So far, haven't really been talking too much about accounting. So information is certainly there in the background. In the first paper, investors have warm glow preferences and they care about how much information they have because they're risk averse. In the second paper, investors and intermediaries have preferences over corporate actions. They still care about risk and return trade-offs. They care about actions, but we haven't modeled a signal per se. In the 2016 paper, we did look at market responses to CSR or ESG reports, but it was, let's say, an initial examination. So one thing that I think as accounting researchers we want to be thinking about is where is the information coming from? So there's lots and lots of empirical studies on corporate disclosure, corporate ESG disclosures. And I think Robin also mentioned a few of those in the chat. So I think they're getting increasing coverage in US journals, also non-US journals, accounting organizations and society, AAAJ, but lots of papers looking at ESG or CSR disclosures. On the theoretical side, which is where I come in mainly, there's a lot of literature on disclosures with cash flow information. So we could think about really the last 40 years, going back at least to the early 80s, in terms of frictions that prevent discretionary disclosure or prevent unraveling in discretionary disclosure environments. A lot of that will carry over, but the third paper that I have for today, which is with Mirko Heinle and Irina Luneva, is maybe trying to get at, is there anything conceptually different with ESG or CSR disclosures? So can we just take what we know about cash flow disclosures and port it over to talking about ESG disclosures, or is there something that's theoretically different? And from our perspective, what's different is the investor valuation having multiple dimensions and different investors potentially caring about different things. So a lot of the prior literature on disclosure really focuses on firms maximizing cash flows, and there's various frictions. Investors want to set price as discounted cash flows, but what's relevant for the ESG space is maybe that's not how the pricing function works, in that there's also these other factors that investors care about. We're seeing this a little bit in some influential finance papers recently regarding like characteristics-based pricing. Maybe ESG are some of those characteristics. And there's some interesting methodologies that, to be frank, I don't fully understand, but they're on my to-do list in terms of estimating these characteristics-based pricing models. Anyway, so in this third paper, theoretical framework for environmental and social impact reporting, we've got one period. The manager potentially now knows more than investors. The manager is going to maximize price net of costs, and I'll get into what their costs are. There's symmetric information among investors. Oh, I should also say this paper was posted to SSRN in the last couple of days, so this paper should be available also. And then the stock price is established via trading between, again, competitive investors. The firm has an action that affects cash flow and ESG performance. It could be a multi-dimensional action. So we've also got issues of the allocation of effort across actions. And there's even a biasing effort that we could think of as greenwashing. We characterize investors as having warm glow preferences that are multidimensional. So they care about cash flows, but they also care about potentially ESG performance. And they might care about E, S, and G or different components separately. So they've got preferences over the actions that the manager takes across multiple dimensions. But some investors also only care about cash flows. So it's a subset that care about ESG. What does the reporting technology look like? So we've got one report that aggregates information about the action that the manager took. There's issues related to congruity and sensitivity, which we've seen in Feltham and Shea about 25 years ago. We also allow for uncertain reporting costs, or an uncertain reporting objective, as in Diane Sweetheart from 2008. Some of you might have seen Fisher and Verrecchia reporting bias paper. It's similar in spirit, but instead of there being uncertainty about how much does a manager want to affect price, you've got uncertainty about how costly is it to bias the report. The reporting technology, again, it generates a one-dimensional ESG report subject to managerial influence. Sorry, Mohammed, what's the time frame?
Now 6 p.m. Cairo time. Yeah.
Can you say again? Sorry.
Yeah. We have a time about 30 minutes.
Okay, so I'll try to wrap it up within the next 5 to 10, and then we can shift to like 100% questions. But I just wanted to make sure I'm not running over right now. Thank you. So in some sense, this paper is trying to capture a lot of the potential variation in what ESG reports are doing. So the ESG reports could be capturing inputs that are controlled by the manager versus outputs that are value relevant, but out of the manager's control. You could have different weightings on different dimensions. So it could be that the ESG report reflects cash flow materiality, or it could reflect the impacts on ESG, or it could reflect a balance between those two in terms of the implications of the actions as they're reflected in the ESG report. And it could be sensitive to managerial bias as well. So some intuition behind the equilibrium, the characteristics of the report affect how investors respond and price the information contained in the report. And how they do that feeds back and affects the manager's incentives to exert the various types of effort, including greenwashing effort. When we think about greenwashing, there's a couple different types of greenwashing that can be characterized in terms of variation in the report. We think of it as there being ex-ante greenwashing, where the report is set up to capture some things better than others, right? So if you're and this gets back to some of the earlier questions, some firms might choose, I think this was Amna's question, but I'm not browsing back in the chat. Some firms might choose ex-ante to capture the things that they're doing well, particularly well, and not capture the things that they don't do very well. So there's a greenwashing in that sense. There's also potentially ex-post greenwashing, which is more straightforward bias. So you might say, we emitted 200 metric tons of carbon, even though your actual emissions were 250. So that's a fairly straightforward greenwashing. The more susceptible that the report is to that greenwashing, the less responsive the investors who care about ESG are going to be to the report. So it's going to be less useful. So they're going to price it less, and that's going to make it less useful in motivating beneficial actions, or actions that are aligned with investor interests, I should say. On the inputs versus outputs side, inputs are less relevant to investors. So we could think of inputs maybe as, what are processes that managers are taking? How much energy are they using? In contrast to things like, what are the outputs? How satisfied are employees? What are the emissions that they're actually creating? Maybe what are the supply chain emissions that might be affected by things like shipping delays that they don't necessarily have much control over. The inputs alone are less relevant to investors who care about what are the ESG outputs of the firm. So an ESG report that focuses only on inputs is going to have less price impact. So that's going to lead to weaker incentives for the manager to exert the ESG related efforts. We could also think about congruence, and this is going back and building on Feltham and Shea. So there's no shortage of what kinds of congruence we can capture, but we focus on 3 in the paper. The ESG report can capture the cash flow impact of action. So we could take we want to figure out what's the cash flow materiality of this, or it could capture the ESG impact of actions. So this might be more aligned with something like a triple bottom line. How much would it have cost to mitigate the carbon that was actually emitted? Or we could think of some values weighted impact of actions. So what's the cash flow effect plus the impact of actions? I'll just finish this slide, then get to the question in the chat. And what we find is that a values weighted report, so something that's consistent with the way that investors on average value the actions that the manager takes, basically maximizes the price response and gets the manager to exert actions that are aligned with investors' preferences. That being said, this can be really hard to implement because each firm has to know about their shareholder base and the preferences of that shareholder base, which of course can be evolving over time. And we don't want to be changing the rules for ESG reporting frequently. We want them to be standard. We want them to be comparable. So this can be something that's fairly hard to implement. What do you think ESG? So Penguo says, do you think ESG affects the intrinsic value or price or both? And what do we model? That's a great question. So by intrinsic value, do you mean like discounted cash flows? Because one thing that I think we have to confront is when we think about ES valuation, when investors or stakeholders care about ESG, is what does intrinsic value mean?
Yes, you're right. Yes, it's a present value of discounted future cash flows I'm talking about.
Okay, yeah, so ESG actions absolutely can, but don't necessarily affect intrinsic value. And I think they can affect it positively or negatively. I think there's a lot of the research that's been published shows, positive effects of pursuing ESG investments. It's possible that some of that is subject to selection effects or maybe non-reporting of negative stuff. I don't know that research showing that it's costly to do emissions mitigation is going to get published, because that just seems really straightforward. But that's where you've got ESG having a negative effect on, potentially a negative effect on discounted cash flows. Of course, it depends on the discount rate. If you've got a long-term project and a high discount rate, then the upfront costs are really going to matter. If you've got a long-term project and a low discount rate, then maybe the carbon mitigation that's going to happen way off in the future is going to be net beneficial. What do we model? Well, in the paper, we model actions that the firm takes that have both cash flow and ESG implications. So we basically have, like, there's an action that the manager takes. There's some sensitivity of, and it's a one period model, so we don't have these timing issues, or these discounting issues, I should say. The action, there's some sensitivity of cash flow to the action. There's also some sensitivity of the other ESG dimensions to the set of actions that the manager takes. And sorry, I misspoke a little bit. There's a set of actions. The set of actions have some cash flow implications and also implications for the other ESG performance dimensions. Does that make sense?
Right. I'm talking about, do you model, value or model price? Because the moment I'm not quite sure. I didn't read your paper. Sorry.
Yeah, I'd be amazed if anyone on the call who, I haven't seen if my co-authors are on it, but I'd be amazed if anyone else on the call had read the paper, because it's only been posted so recently. In some sense, we model both. So the actions have assumed actual effects on cash flows and ESG, but the price is set by investors according to their willingness to pay for the shares. And some investors only care about the cash flow effect. Some investors also care about the ESG effects, and they trade with each other to establish a price. And the price, like in most competitive utility models, it's it basically equates their marginal utility with paying $1 for another share. Does that make sense? So there's cash flows, but there's also price. And the key is price is set by the market, by investors. Whereas the cash flow effects are really a function of what's the technology that you assume. What's the production technology? David, thank you for posting the link to the paper. And just my sense, given the nature of the talks that I've seen, was it'd be nice to talk about a few papers, but not dig into equations too much. So I just chose to go with that route as opposed to presenting the models per se. Zhang says, is investor sophistication associated with ESG preference? I think that's a great question. Do we know if retail investors or institutional investors have more ESG oriented preferences? There's some interesting research on that front. So I'm blanking on the authors. I think Claire Wang might be one of them, but she and a couple of co-authors, who I really apologize for blanking on their names, have an interesting paper looking at using Robinhood data to look at whether retail investors respond to ESG information releases, and they find that they don't. So retail investors, at least the Robinhood investors, seem not to respond. Certainly, if you look at what institutional investors are saying, it seems like they care a lot about ESG. And there's a lot of papers. I think there's a burgeoning almost sub-literature. I think there's at least a couple papers on whether institutional investors on average walk the walk or talk the talk. So even if you're a socially responsible investor, is that actually reflected in your portfolio? Is that reflected in the stewardship activities that you take? Or is that just a label that you put on to try and attract fund flows? And yeah, I think there's research on both sides. Gosh, why do I think CSR has fallen out of favor and being recast as ESG? I have no idea. That sounds like a sociology question, sociology of science. It's a good question. I don't know why this has changed. Okay, so on the incentive side, getting back to the paper, and I really appreciate these questions. I think they're interesting in it, and I do really like the discussion. I'm glad people are interested in this topic broadly. So stronger investor reactions to the ESG report lead to, and when I say investor reactions, going back to the earlier question, Penguo's question, that means that the report has a stronger effect on stock price. That increases the manager's incentives to take ESG related actions, but it also increases incentives for greenwashing. So an interesting, most of us, I think when we think about greenwashing, it's like, oh, that's terrible, firms are greenwashing. And prima facie, it's bad. But in some sense, greenwashing implies that managers care about reported ESG performance. So if it didn't matter, presumably they wouldn't do that. So we might be able to think about the fact that managers are greenwashing as at least being a baby step in the right direction. If we think managers caring about this stuff is a step in the right direction. How one can capture ex ante and ex post greenwashing. I think that's a really good question. I think that's a great question for empiricists to try and tackle. So I think that's really like, are there settings where those can be differentiated? Is a good question that we don't, that I would leave up to, at this point at least, is not addressed directly in this research. I think there's examples, but we don't have much guidance on particular measures. I saw a hand go up and then it went down, so I'm going to continue. But if you do have a question and you want to chime in, please feel free to put the Zoom hand back up. Okay, so there's real trade-offs to be made. How much to regulate versus how much to leave up to investor demand for information. How do we define materiality? Going back to Penguo's question, is it materiality in terms of affecting cash flows? Is it materiality in terms of the production technology? Or is it materiality in terms of how ESG actions are reflected in price? And those, I think, are conceptually different enough for the difference to be important. So last couple slides. Where do we stand? Well, there's a lot of investor interest in ESG. Seems to be supported by some, but again, not all of the evidence. And particularly that paper I just mentioned, the irrelevance of ESG disclosure to retail investors, evidence from Robinhood. I'm actually going to click the link that David said so I can actually mention the authors. Austin Moss, James Naughton, and Claire Wang. It's a nice paper. So second, of course, there's social interest in ESG, and that interest can cause firms to internalize some externalities because at the end of the day, managers are also people. They're going to have preferences that, you know, they've got to go home, they've got to go to clubs and such, they're going to interact with people who might make their lives worse if they're doing terrible things. On the investor side, though, how societal interest gets incorporated into firms' objective functions, if we go back to traditional thinking about firm managers wanting to maximize price or maximize their compensation, the internalization of societal interest depends on market structure and information. And I think how the information gets incorporated is really a place where we as accounting researchers can play a nice role. Some important dimensions to consider, and I think this gets a little bit at the question in the chat too, this issue of ex ante versus ex post greenwashing. I think there's open questions about what are ESG investor motivations. So is it warm glow? Is it the impact on corporate actions? Pastor, Stambaugh, and Taylor have another interesting paper on correlated exposure. So if I live on a coastal plain, I might be really concerned about sea level rise. So I might want to invest in a way that hedges my sea level rise risk. Or I might want to take actions that help reduce that. There's joint effects of actions on ESG and CSR performance. So there's trade-offs between these, getting back to Penguo's question again, that are in some ways innate to the technology. But those trade-offs will change as technology advances, or as technology changes. One thing I haven't gotten into is voluntary disclosure. So in some other research, Mirko and I actually have done some modeling of how important uniformity is for mandatory disclosure. Almost all of the disclosure in this area, with the exception of some that we've talked about earlier, is voluntary. So there's questions about the provision, choices, and comparability of voluntary disclosures. Jeff Hales and some co-authors have some recent work. Jeff Hales is long-term academic, but also recently I think president of the SASB. So he's got a nice recent paper with George Serafim and another co-author talking about how the SASB has helped coordinate firms' voluntary disclosures, at least in terms of what they're talking about, which has facilitated comparability. And of course, ESG matters for other markets. So willingness of employees to work for firms can depend on ESG. Willingness of customers to buy. ESG is getting incorporated into debt securities. So that's an interesting area. Also getting incorporated into supplier contracts. Of course, supply chains are really important in the ESG space. Firms are facing increased scrutiny over the political influence that they exercise, which could be an aspect of ESG performance and could also affect their ability to do things like pollute, or their benefits or payoffs from not polluting. It could affect the regulatory risk that they face. And all of these, I think, are mechanisms that link ESG actions to cash flows that firms face also. So a lot of the motivation for why do firms do well by doing good? Well, it's because if you're a company that has a mission and you're doing good and you're not destroying the environment, people are going to be more willing to work for you. It's going to be easier for you to hire. It's going to be easier for you to sell socks and shoes and whatever else it is that you sell. Okay, overall, I think this is a really exciting area. There's a lot of fundamental questions. There's a lot of scope for interesting research. And really where I think the research differentiates is that you've got investors or individuals who value ESG above and beyond cash flows. Okay, so I think we've seen that in various flavors, probably since economics research started, but bringing it back into the neoclassical economics framework that has a really cash flow, net present value focused foundation, I think will allow for scope for interesting questions and interesting research. I mean, bringing the same rigor and the same concerns about identification, concerns about getting preferences right and things like that. But again, I think there's a lot of interesting opportunities. Okay. Thanks very much. I'm absolutely happy to try and address some questions or facilitate a discussion. I think there's a lot of interesting things that have been brought up already, but yeah, so I'd say at this point, the floor is open.
Yeah, thank you very much, dear Professor Henry Friedman, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question.
And also just thanks to everyone for participating. Really appreciate it. Anyway.
I can kick us off if you have time. More of an opinion question. Just wanted to get your take on it. You talk about greenwashing. Do you think the rating agencies can see through that? Do you think the way that they come up with their rating, whether it's CSR, ESG, whatever, do you think they do an appropriate job of seeing through those greenwashing efforts when they do their ratings?
I don't know. I don't know. I mean, I think people have been doing research on whether credit rating agencies have been getting it right or systematically wrong, and credit rating agencies and analysts' recommendations, at least. I guess recommendations, forecasts are a little bit less similar, but something like recommendations or target prices and the certainly credit rate, like categorical credit ratings, seem to be really closely related in spirit to what the CSR ratings firms are trying to do. I don't know that I think there's a lot of interesting facts pointed out about the credit rating agencies and analysts. The frictions probably carry over, but I don't think, like, we could take your question to those two more traditional settings, and I don't think that question's really been settled there. I think there was one of our PhD students at UCLA sent me a paper in recently. I think one of the authors was at the Russell Index Manager company, and I'm sorry, I'm blanking on it, but I've only seen one paper that's trying to get in the accounting space that's trying to get at greenwashing. I've seen some other papers that have used real world EPA data. There might be some papers. So I think there's some promising research that uses information or data that's not targeted at investors to evaluate the statements that firms are making and they're related to ESG, typically in their annual reports or CSR reports. I don't know that I've seen too many papers using that to evaluate how well the various ESG data vendors are doing. But I think that it sounds like an important question.
Mhm.
And what's neat is there's a lot of, like in the US, there's all this data that the EPA has on actual emissions. I've seen people using Glassdoor data to get at like, how do firms seem to be actually treating their employees? Granted, there's a tilt towards like tech firms. So it's a little, you're not going to be capturing working conditions in parts of the world that might be more problematic. And then I think the paper that comes to mind, I think they were looking at greenwashing relative to the scores that they got. I think they were taking the ESG scores from the data vendors as like ground truth, and then evaluating the firm's statements relative to that.
Mhm. That's good. Thank you.
Sure. Yeah, it's a long non-answer. Like at the end of the day, I don't know, but it means there's research opportunities.
Hey, David, you have a question?
So I was going over your paper and I saw that there's a debate on how trading activity and investor engagement affects firms' social impact. And I am definitely going to read over your paper more. As a student, I'd like to learn more about, how to do theoretical work on ESG disclosures. So I was actually, riding bicycle today by the river with Uno Jung from Jung and Kwan 1988. And I was talking to him about disclosure theory and how there's like a discretionary disclosure available, and how at his time, this trend wasn't available, this ESG trend. But now in the 21st century, we have this ESG disclosure, so we can start applying the theoretical framework in this new setting, which you're doing now. And it's so interesting how I was just talking to him about it over the bicycle ride. And now I get to actually, listen to you talk about it a bit more. Could you share a little bit more about like how you do the theoretical work on this ESG disclosure, please?
Yeah, I mean, just very briefly, it's similar in spirit to, well, I guess a big difference between empirical is sometimes you say like, oh, there's this really interesting data, what can we do with it, right? Or like, but in some sense, there's a couple different approaches. One is, you can take an existing model and say, what happens if we add this other feature to it? And sometimes you find the model is no longer tractable. Sometimes you find something interesting out of that. Sometimes you could separately start from, I want to write down a model that captures the first order effects in a given setting. So you've got to make decisions about what do you think the first order effects are. You've got to make decisions about what to leave out. But in some sense, the similar to empirical research, like talking about it's all well and good, but the only way to really start, it sounds stupidly tautological, but the only way to do it is to start doing it. So you might like go back to go back to Jung and Kwan and see if there's like, can you solve their model? So can you take their assumptions and solve through it, develop a couple of comparative statics? Maybe you can do another comparative static, and comparative static is just taking equilibrium conditions and taking a derivative on those, right? So mathematically, it's not conceptually complicated. And the harder part potentially, if you can write down the derivative, is evaluating it and trying to glean insights from it. So what does that tell you about how the frictions in your model interact to lead to outcomes? Was that helpful at all? I think you asked like how do you do this question, and in some sense the answer is you just do, like, pick a place to start and just start. But usually it's like similar to empiric, like you replicate something and then you see if you can build on it a little bit and see if you get something interesting off of building on it a little bit, or you just scrap everything and say, I'm just going to get totally new data because this is the best data for addressing this specific research question.
I really appreciate the response that you gave me because it was very helpful. It seems like there are some corollaries that I should, see whether I can like check empirically too. Then it just is very interesting to see your paper on SSRN. I'm definitely going to read this. I think the other participants here, if they have time, they should also read the paper. One more corollary that I wanted to check with you is from Jung and Kwan 1988. It talks about this threshold where if there's some like negative news about a firm by a third party, it could be an analyst or it could be media coverage, then because the firm is not as bad as the third party says, they're more willing to provide voluntary disclosures. So in regards to this setting of ESG, are these firms that are portrayed more negatively by the media more likely to provide voluntary disclosures on ESG?
It could be. I don't, that sounds like an empirical question. I don't have a paper that comes to mind that addresses that. It doesn't mean it's not out there just because there's a lot of papers on ESG that are out there. If you, certainly if you wanted to model it, one thing to do is just say, well, let's just think about this in terms of the, Dai, Jung and Kwan setting. The difference that I think would be useful to point out there between that and an ESG setting is there's one dimension, there's only cash flows, everyone cares about cash flows. So if you have ESG information that comes out, that it lowers investors' belief, it basically lowers what in their model is the prior belief going into the disclosure game. And since the prior belief is lower, now more signals are relatively positive. And I think that intuition plausibly carries over to a setting where you've got investors who care about ESG, and maybe ESG is, and where ESG is value relevant, and the managers care about value, or care about the stock price. It seems like that would very much carry over. Again, I haven't seen an empirical paper testing that specific mechanism, but it seems reasonable. You could do it in the Jung and Kwan framework. You could also like add another dimension and see if that makes a difference. Like there might be interactions between cash flow and ESG information that come out of that could be interesting. There's definitely papers that look at discretionary disclosure with multiple dimensions of information, usually characterized as multiple dimensions of cash flow related stuff. Unfortunately, I don't have a specific citation right now. One other area, and we're getting it to time. Let's see, I guess I'll just post this in the chat. There's a nice voluntary disclosure paper by Jerome Suis. let's see if I can, yeah. So I'm just going to paste that into the chat window. Voluntary disclosure of information when firms are uncertain of investor response. And I think ESG is an area where investors are likely to, or where firms are likely to have uncertainty about how much investors value ESG. So that's, yeah, it's another nice favor. I think that's time. Is that right, Mohammed?
If anyone have any questions, you can open your mic and ask your question. Are there another question? Thank you very much, dear Professor Henry Friedman, for your contribution and your effort. Thank you very much. So it means that remains for me to say thank you everyone that joined us, and I thank you very much for taking the time out to present it to us today, dear Professor Henry Friedman. It's been really appreciated. Thank you very much.
Thank you. Really appreciate everyone's participation and questions. Thanks a lot.
Thank you.
Bye.
And I hope to see you soon in Egypt.
Yeah, looking forward to it.